Hello students, welcome to EPG Parsala. I am Dr. Sujit Sharma from Government College Nadon, Himachal Pradesh. Today we are going to talk on module International Financial Reporting Standards from paper Accounting and Financial Analysis. After studying this module, the students may able to understand the basic structure of International Financial Reporting Standards, understand the components of International Financial Reporting Standards, tell interpretations originated from the International Financial Reporting Interpretation Committee and Standing Interpretation Committee, explain various International Financial Reporting Standards and International Accounting Standards. Financial Reporting Standards is a set of accounting standards which is developed by International Accounting Standard Board. The need of International Financial Reporting Standards arise due to growing international shareholding and trade. International Financial Reporting Standards are the rules or principles which are used by accountants to maintain books of accounts of a company. Further, books of accounts prepared according to these are relevant, reliable, understandable, and comparable. The components of International Financial Reporting Standards can be divided into two parts. One is standards and second is interpretations. Standards prescribe rules or accounting treatments for various individual items or elements of financial statements. These include International Financial Reporting Standards, International Accounting Standards. Whereas interpretations supplement standards. They deal with more specific situations which are not covered in standards itself or issues that arouse after publishing of certain standards. Interpretations include interpretations originated from International Financial Reporting Interpretation Committee and Standing Interpretation Committee. The components of International Financial Reporting Standards are revealed in this table. It is clear from this figure that International Financial Reporting Standards can be divided into two parts. First is standards and second is interpretations. Standards. Standards prescribe accounting treatments. Standards disclose or tell about the accounting treatments for various elements of the financial statements, whereas interpretations are issued to supplement the accounting standards. These deal with more specific situations, the situations which are not covered in the standards. The situations which are not covered under the standards, these are covered under interpretations. Further, interpretations also deal with issues that arouse after publishing of certain standards. If some issues arouse after the publishing of the standards, then interpretations regarding that standard can be issued. So, interpretations are mainly issued for three purposes: to supplement the standards, to deal with more specific situations, or to deal with the issues that arouse after publishing the standards. Standards can be divided into two parts: International Financial Reporting Standards and International Accounting Standards. The International Financial Reporting Standards are issued by International Accounting Standard Board, whereas International Accounting Standards are issued by International Accounting Standard Committee. This figure shows about International Accounting Standards. International Accounting Standards are issued before 2001. These are also called older standards, which are issued by International Accounting Standard Committee. This figure makes clear that these standards are issued before 2001, and further these are issued by a committee, that is International Accounting Standard Committee. International accounting standards are shown in this table. This table includes description of the standard, when this standard was issued and become effective, and what is the present position of the standard. IAS 1 is related with presentation of statements. It was issued in 1975 and effective from 1st January 1975. Inventories, the IAS 2 is related with inventories, issued in 1976, effective from 1st January 1976. IAS 3, 4, 5 and 6 are now withdrawn, and these are superseded by some other international accounting standards. IAS 7 is related with statement of cash flows, issued on 1977, effective from January 1st, 1979. IAS 8, accounting policies changes in accounting estimates and errors are described in this standard. These are issued on 1978, effective from January 1st, 1979. IAS 9 is withdrawn and superseded by IAS 38. IAS 10 is related with events after reporting period, issued in 1978, effective from January 1st, 1980. IAS 11 is related with construction contracts, issued on 1979, effective from January 1st, 1980. IAS 12 is related with income tax, revised in 1996, issued in 1979 and effective from January 1st, 1981. IAS 13 and 14 is withdrawn now. IAS 15 is related with information reflecting the effects of changing prices, and this standard was issued in 1981 and become effective on 1st January 1983, and now it is withdrawn. IAS 16 is related with property, plant and equipment. IAS 17 is related with leases, issued in 1982, effective from January 1, 1984. IAS 18 is related with revenue, issued in 1982, effective from January 1st, 1984. IAS 19 is concerned with employees benefit. It was issued on 1983 and effective from January 1st, 1985. IAS 20 is related with accounting for government grants and disclosure of government assistance, issued in 1983 and effective from 1st January 1984. IAS 21 is related with effects of changes in foreign exchange rates, issued in 1983 and effective from 1st January 1985. IAS 22 is withdrawn now. IAS 23 is concerned with borrowing cost, issued in 1984, effective from January 1st, 1986. IAS 24 outlines related party disclosures, issued in 1984, effective from January 1st, 1986. IAS 25 is withdrawn. IAS 26 is related with accounting and reporting by retirement benefit plans, issued in 1987, effective from 1st January 1988. IAS 27 is related with separate financial statement, issued in 1989, effective from 1st January 1990. IAS 20 is concerned with investment in associates and joint ventures. It was issued in 1989, effective from January 1st, 1990. IAS 29 outlines financial reporting in inflationary economies, issued in 1989, effective from January 1st, 1990. IAS 30 is withdrawn now. IAS 31 is related with interests in joint venture, and it is withdrawn now. IS 32 is related with financial instruments issued in 1995, effective from 1st January 1996. IS 33 is related with earning per share. IS 34 is related with interim financial reporting. IS 35 is related with discontinuing operations, and IS 36 is related with impairment of assets. IS 37 is related with provisions, contingent liabilities and contingent assets. These are issued in 1998 and effective from 1st July 1999. IS 38 outlines intangible assets. IS 39 is related with financial instruments recognition and measurement, and this was issued in 1998, effective from January 1st, 2001. IS 40 is concerned with investment property, issued in 2000, effective from January 1st, 2001. IS 41 is related with agriculture, issued in 2000 and effective from January 1st, 2003. What is the meaning of International Financial Reporting Standards? International Financial Reporting Standards are the standards issued after 2001. International Accounting Standard Committee was replaced by International Accounting Standard Board in the year 2001. And the International Accounting Standard Board has the power to develop international financial reporting standards and to approve interpretations of those standards. IFRS reporting standards, International Financial Reporting Standards, are developed by International Accounting Standard Body, and these are issued after 2001. It is revealed by this figure that these standards are developed by board, not by the committee, and these are issued after 2001. In this table, International Financial Reporting Standards are given, and table includes the description about the standard and when these standards were issued and become effective. Standard 1 is related with first time adoption and International Financial Reporting Standards, issued in 2003, effective from January 1st, 2004. Standard 2, share-based payment, issued in 2004, effective from January 1, 2005. Standard 3 is related with business combinations, issued in 2004, effective from April 1st, 2004. IFRS 4 outlines insurance contracts. These are issued in 2004, effective from 1st January 2005. IFRS 5 non-current assets held for sale and discontinued operations. These are issued in 2004 and effective from January 1st, 2005. IFRS 6 is related with exploration for and evaluation of mineral resources. IFRS 7 is related with financial instruments and disclosures. IFRS 8 is related with operating segments. IFRS 9 is related with financial instruments. IFRS 10 or International Financial Reporting Standard 10 is related with consolidated financial abatements, and it is issued on 2011, effective from January 1st, 2013. Standard 11 is related with joint arrangement. It is issued on 2011 and will be effective from 1st January 2013. And Standard 12 concerned with disclosure of interest in other entities, issued in 2011, effective from 1st January 2013. Standard 13 is related with fair value measurement, issued in 2011, effective from January 1st, 2013. Standard 14 is related with regulatory deferral accounts, issued in 2014, effective from January 1st, 2016. IFRS 15, revenue from contracts with customers, and it is issued in 2014 and effective from January 1st, 2018. Interpretations. Interpretations are divided in two parts. There are two types of interpretations, and these are shown in this figure. First interpretations are issued by International Financial Reporting Interpretation Committee, and second are issued by Standing Interpretation Committee. This figure shows the interpretations from International Financial Reporting Interpretations Committee, and these are issued after 2001. These interpretations were issued after 2001, and these were issued by International Financial Reporting Interpretation Committee. Interpretations from International Financial Reporting Interpretation Committee are shown in this table. This table provides description and present position, and it is clear from the table that interpretation number 3, omission rights, is withdrawn now, whereas all other interpretations are effective. Interpretation 1 is related with changes in existing, decomposition, registration and similar liabilities. 2 with members' shares in cooperative entities and similar instruments. 4 with determining whether an arrangement contained a lease. 5 right to interest arising from decomposition and registration and environmental rehabilitation fund. 6 with liabilities arising from participating in a specific market, waste, electrical or electrical equipments. The interpretation number 8 and 11 are withdrawn and superseded by International Financial Reporting Standard 2, whereas interpretation number 7, 9, 10 are effective. At present, this table shows the interpretation number 12, 13, 14, 15 and 16. All these interpretations are applicable in present also. Interpretation 17, 18, 19 and 20 and 21 are disclosed, and interpretation number 17 is related with distribution of non-current cash assets. 18 with transfers of assets from customers. 20 with stripping cost in production phase of surface mine, and 21 with levies, and all are applicable in present also. Interpretations from Standing Interpretation Committee are shown in this figure. It makes clear that these are the interpretations which are issued by Standing Interpretation Committee, and these were issued before 2001. These are not issued presently, these were issued before 2001. Interpretations from Standing Interpretation Committee are shown in this table, and it is clear from the table that Standing Interpretation Committee interpretations 1, 2, 3, 5, 6 are withdrawn now, and these are superseded by International Accounting Standards. Only interpretation number 7, introduction of the euro, is applicable at present. It is clear from this table that interpretation number 8, 9, 11, 12, 13, 14 are withdrawn now and not applicable at present because these are superseded by International Financial Reporting Standards or International Accounting Standards. It is revealed from this table that interpretation number 16, 17, 18, 19, 20 and 21 are withdrawn, and these are superseded by International Accounting Standard, which are issued and not applicable at present. It is depicted by the table that interpretation number 22, 23, 24 and 26 is withdrawn, and these interpretations are withdrawn and superseded by International Financial Reporting Standards or International Accounting Standards and not applicable in present. This table shows that the interpretation number 28, 30, 33 are withdrawn and superseded by International Financial Reporting Standards or International Accounting Standards and not effective at present. It is important to understand the various International Financial Reporting Standards, and in this picture we have studied the International Financial Reporting Standards in brief. Overview of these standards are given, and IFRS 1 is related with first time adoption of International Financial Reporting Standards. It prescribes the procedure for the first time adopters, the procedure that an entity must follow while adopting International Financial Reporting Standard for the first time for preparation of its financial statements. Further, it also specifies the exemptions that are available to the business entity from the journal requirement to comply with each International Financial Reporting Standard effective at the end of its first reporting period. IFRS 2 describes the rules that should be used for reporting the share-based payment transactions, including transactions with employees or other parties in an entity's financial statement or balance sheet. IFRS 3 deals with business combinations and prescribes accounting rules that should be adopted when acquirer obtains control of a business by acquisition or merger. IFRS 3 clarifies how to identify business combinations and prescribes the acquisition method for its accounting. IFRS 4 is related with insurance contract. Is the standards dealing with the all insurance contract, including reinsurance contract. It defines the rules of financial reporting for insurance contracts. International Financial Reporting Standard 5 is related with non-current assets held for sale and discontinued operations. It describes conditions when the entity shall classify a non-current asset or disposable group as held for sale. Make clear how one to account for non-current assets held for sale. Explains the term discontinued operations. Specify disclosure required for discontinued operations and disposals of non-current assets. International Financial Reporting Standard 6 clarifies financial reporting of the expenditures incurred for the exploration and evaluation of mineral sources. It prescribes the exploration and evaluation assets should be measured at cost. International Financial Reporting Standard 7 requires the disclosure of information about significance of financial instruments for financial position and performance of an business entity, the nature and extent of risk arising from those financial instruments. It clears both of these things. Then IFRS 8 is related with operating segments. It applies to those entities whose debt or equity instrument are traded in a public market and provides the information that an entity must disclose about its business activities. It must disclose about operating segments, product and services, the geographical area in which it operates, and its major customers. It is compulsory for these organizations to disclose all these informations. IFRS 9 is related with financial instruments, and it is related with recognition, classification, measurement, derecognition of financial instruments, and hedge accounting rules. IFRS 10 is related with consolidated financial statements. It outlines when investor controls the investee. Further, it also outlines requirements for the preparation and presentation of consolidated financial statements. IFRS 11 is related with joint arrangements. It outlines principles for reporting of entities that jointly control an arrangement. Joint arrangements are arrangements in which two or more parties have joint control. IFRS 12 is related with disclosures of interest in other entities, and according to this standard, disclosures that should be provided in the financial statement with regard to interest in subsidiaries, joint arrangements, associates, or unconsolidated structured entities. IFRS 13 is related with fair value measurement. IFRS 13 provides the framework for fair value measurement and disclosures about fair value measurement. IS 8 is related with accounting policies, changes in accounting estimates and errors. It prescribes the criteria for selecting and changing accounting policies. Further, it also prescribes the accounting and disclosure of changes in accounting policies, changes in accounting estimates, and correction of errors. IS 10 is concerned with events after the reporting period. It provides the rules when an entity should adjust its financial statements for events after the reporting period, together with necessary disclosure. IS 11 outlines the accounting treatment of revenue and cost associated with construction contracts. The primary issue is allocation of contract revenue and contract costs into individual periods in which construction work is performed. IS 12 prescribes the accounting treatment of income tax, including deferral taxes. IS 16 deals with accounting treatment of property, plant, and equipment with focus on recognition of assets, determination of their carrying amount or revalued amounts, depreciation charge, and impairment losses to be recognized. IS 17 is related with leases, and it prescribes accounting policies to be applied in relation to finance and operating leases for both lessees and lessors. IS 18 is concerned with revenue. It prescribes the accounting treatment for revenues that arise from various types of transactions such as sale of goods, rendering of services, receiving interest, dividends, and royalties. IS 19 is related with the employees' benefit. It prescribes the accounting treatment and disclosure for all types of employees' benefit. An entity shall recognize appropriate liability when employee has provided service in exchange for benefits to be paid in the future, and expense when entity consume the benefit from service provided by employee. IS 20 prescribes the accounting treatment of various government grants and other forms of government assistance, together with related disclosure requirements. IS 21 is related with the effects of changes in foreign exchange rates. It prescribes how to include foreign exchange, currency transactions, and foreign operations in financial statements of an entity, and how to translate financial statements into a presentation currency. It defines which exchange rate to use and how to report the effect of exchanges in exchange rate in the financial statements. IS 23 is related with borrowing cost. It prescribes the accounting treatment of borrowing cost that may include interest expenses, finance charge in respect of finance leases, exchange differences from foreign currency borrowings regarded as adjustment of interest costs, etc. IS 24 outlines number of disclosure for related party transactions. IS 26 is related with accounting and reporting by retirement benefit plans. IS 26 prescribes measurement rules and necessary disclosures for preparing of retirement benefit plans, pension plans, retirement benefit schemes, etc. Now, we will discuss in brief the International Accounting Standards. The International Accounting Standard 1 is related with disclosure of accounting policies. It defines basis for presentation of financial statements. IS 1 defines a complete set of general purpose statements that contains 5 basic components. The first is statement of financial position. Second is statement of profit and loss account and other comprehensive income. The next is statement of changes in equity, statement of cash flows, and last, notes with summary of significant accounting policies and other explanatory information. IS 2 is related with valuation and presentation of inventories. IS 2 defines inventories, specifies what the cost of inventories shall comprise. It provides the basis of valuation of inventories and disclosure of inventories. IS 7 is related with cash flow statement. It explains that requirement for preparing information about historical changes in cash and cash equivalents of an entity by means of statement of cash flow during the period. IS 34 prescribes minimum content of an interim financial report. That what should be the minimum content of an interim financial report and the principle for recognition and measurement in complete or condensed financial statement for an interim period. IS 36 is related with impairment of assets. It prescribes the procedure that ensure that an entity's assets are carried at no more than their recoverable amount, prescribes how to recognize the impairment loss. IS 37 is related with provisions, contingent liabilities, and contingent assets. This IS provides the recognition, criteria, and measurement basis of provision, contingent liabilities, contingent assets, together with necessary disclosures about their nature, timing, and amount. IS 38 is related with intangible assets. It prescribes the accounting treatment for intangible assets that are not dealt specially in other or another international accounting standard or international financial reporting standard. IS 27 is related with separate financial statements. It prescribes the rules for preparing separate financial statements for investments in subsidiaries, joint ventures, and associates. IS 28 prescribes accounting for investment in associates in which an equity exercises significant influence and specified application of equity method for accounting of investments in associates as well as investment in joint ventures. IS 29 is related with financial reporting in hyperinflationary economies. It prescribes rules for financial reporting of any identity whose functional currency is in the currency of hyperinflationary economy. IAS 32 is related with financial instruments. It establishes the principle for presenting financial instruments as liabilities for equity and offsetting financial assets and financial liabilities. IAS 33 is related with earning per share. It prescribes principle for determination and presentation of earning per share in order to improve performance comparison between different entities or between different reporting periods of the same entity. Applies to all entities whose share are publicly traded or are in the process of issuing securities to public. IAS 39 is related with financial instruments. It establishes principle for recognizing and measuring financial liabilities and some contracts to buy or sell non-financial items. IAS 40 prescribes the accounting treatment for investment property and related disclosure requirements. IAS 41 prescribes the accounting treatment and disclosures related with agricultural activity. So students, let us now summarize what we have learned in this module. The need of international financial reporting standards arise due to growing international shareholding and trade. International financial reporting standards are the rules or principles which are used by accountants to maintain books of accounts of a company. Further, books of accounts prepared according to these are relevant, reliable, understandable, and comparable. IFRS include the following components: International Financial Reporting Standards, International Accounting Standards, interpretations originated from International Financial Reporting Interpretation Committee, and Standing Interpretation Committee. Thank you.